Now right here from Roundhill, it says, what is a covered call ETF? A covered call ETF is an investment fund that uses a covered call strategy to generate income for investors. It holds a portfolio of stocks or other assets and then sells call options on those assets. This generates premiums which are then distributed to investors as income. Covered call ETFs can be particularly appealing to income-focused investors looking for steady returns and willing to trade some growth potential for reduced volatility. Now, as of right now, I think it's a better time than ever to make a video basically giving you guys an ultimate guide, a master guide on what covered call ETFs are, what some of the pros are, what some of the cons are, where I see them to be fit in a long-term portfolio, and everything else included. And this is simply because covered call ETFs are all over the place now in the market. It seems like there's a few new ones every single trading day, and they are definitely not all created equal. Some of them are much more volatile, some of them track a single stock, some of them track an entire index. There is a lot to go through. But one thing's for certain, if you are an investor that's interested in covered call ETFs like I am, then make sure to stick around, drop a like down below, and let's get right into it. My A to Z dividend investing ebook has helped countless dividend investors get started with their journey. And my custom dividend tracker that I'm constantly using here on the channel has also help so many investors stay on track and allow them to see their dividend income in real time. Well, today I have another treat for you guys. I'm not only going to offer you my A to Z dividend investing ebook and the custom dividend tracker, but also just for a short limited time, I'm going to be adding in my brand new weekly dividend blueprint ebook to show you how you can get started with weekly dividend ETFs and add this into your investing strategy. This offer is not going to last long, so go ahead and click the first link down below in my description, and you're going to get both ebooks and the custom dividend tracker bundle. But like I said, please act fast because this won't be around for long. Now let's get back into the video. Now before I share with you guys the ultimate guide, giving you everything you need to know and more about covered call ETFs, look at this for example. This is a total return chart comparing TSLY to QYLD, compared to the SPY, compared to SPYI, and lastly compared to QQQI. Now this is since around February of 2024. Look at the total return performance of all these different ETFs. Now again, total return is dividends plus price return included. And what's crazy enough is that over this time frame at least, TSLY has outperformed everything including the SPY, up around 45.56%, which might shock some investors out there because a lot of us look at TSLY as an absolute NAV decaying yield trap, but the income potential of the fund has definitely helped it. Now without TSLY, comparing a lot of these different covered call ETFs even to the SPY, you can see that for the most part, they've all done pretty decent. Now with that being said, I do think there are tons of things to look out for when it comes to investing into covered call style ETFs. So let's go through the ultimate guide and share with you everything that I came up with. So let's first go over some of the pros when it comes to covered call style ETFs. One of the most obvious pros I think we can all agree on is the fact that some of them pay 10% to 20% to even 50 or 100% in annual yields. But for the most part, a lot of times they pay between, let's say, 10 and 20%. Now, again, we're talking about names like JEPB, JEPQ, SPYI, even names like QYLD. There's so many ETFs out there that utilize this covered call strategy. But again, they are not all created equal. Another pro of covered call style ETFs is definitely the fact that they offer consistent income. Again, some more than others. Depending on the covered call ETF, some of them are going to pay you income every single week or even every single month. And again, some of them are going to pay much more consistent income than others. Some of them might base their income off of the previous month's performance, or some of them might have a targeted amount that they're going to pay you more or less the same amount every single month. Now, this consistent income can be very helpful if you're an investor trying to build out a long-term portfolio to use for things like expenses or to pay for things like your bills later on in the future, which definitely hits close home to me because I personally, as a 32-year-old investor, am looking to build out a long-term portfolio that's going to take care of all my expenses and then some sometime in the future. Now, another pro of covered call style ETFs, lower volatility. Covered calls can reduce some downside risk, although not a ton in most cases. Now, because of the covered call overlay, if there is some downside in the market during a certain time frame, the covered call premium is going to make up for some of the loss. The covered call option premium can make up for some lost ground, but again, this isn't necessarily something that's all that impactful, but still it is a pro, and that's why covered call ETFs for the most part can be a little bit less volatile than the underlying that they're tracking. Another pro of covered call ETFs is, of course, that it's hands-off investing. You don't need to learn how to option trade. You don't need to be on your computer or your phone every single day checking in on things. A lot of times these covered call strategies are actually actively managed, so you're paying an expense ratio in return to have a professional basically do all of it for you. Next, another pro is can be great to generate consistent income in certain market conditions. Now, over the last decade of investing, more or less, I've seen this multiple different times. If the market's trading more or less sideways, maybe there's some decent volatility, you can earn a ton of income while having your underlying ETF that you hold on to basically trade sideways also. Where if you just held onto the growth underlying, you probably wouldn't earn any income and your portfolio would more or less stay the same. Now, this can be great, especially if you think about things like the lost decade, or if the market just trades more or less sideways inside of a pretty tight channel over a long time time frame, the covered call strategy can be amazing. Now, one more side note on this, certain holdings in my personal portfolio like Realty Income or even Verizon stock, which I hold several thousands of shares of, for example, I sell covered calls on those individual names on my own, and during the last several years, the market's basically traded sideways. So even though the price performance has not been great when it comes to Verizon stock or Realty Income, for example, I've been able to generate a ton of extra income plus dividends, of course, during that time frame. Now, another pro is that it can be used for an income-focused portfolio, and this is definitely key. If you're looking to build a growth-style portfolio, then covered call ETFs are not necessarily going to match what you're looking for. There's probably going to be more growth in growth-style ETFs. Now, the last pro that I will say about covered call style ETFs, and also comment down below any ideas that you guys have, they can be used to buy other assets ongoingly. So if you hold on to a covered call ETF that, let's say, just trades sideways more or less, something like SPYT, but pays you 33 cents, 32 cents per share per month, if you can generate, say, hundreds or thousands of dollars per month based off of that income, you can, of course, then use that income to buy yourself some shares of VIG, or buy yourself some shares of Apple stock. You can use the money for whatever you want. So I've seen investors talk about this before, building out an income producing portfolio that can sometimes be pretty tax efficient, depending on what you're buying into, of course, and then using that cash to buy growth names or more income producing names. It can be an interesting strategy. Now we're going to go through some cons, and trust me, there's also some big time cons when it comes to covered call style ETF investing. The number one con is probably the capped upside. You are going to be giving up big gains in bull markets because of the covered call overlay. Now, the way a covered call works is that you're going to get paid premium, but your upside is going to be capped. Now, again, this can be good during a sideways or down trading market in certain circumstances, but if the market is ripping, if things across the market are moving up at a massive clip, your upside is going to be capped, which means you probably could have made more money if you just invested into the underlying naked. Now, the next thing is going to be tax inefficiency. Many distributions are taxed as ordinary income, but also sometimes not. Now, this is also important to look into every single individual covered call style ETF, talk to the fund managers even if you want to, and figure out exactly how the dividends or distributions are going to be taxed. That is very, very important to look into. Now, the other obvious con when it comes to covered call style ETFs is that they're not always sustainable. Some high yields come at the cost of capital erosion. We've seen this multiple times through multiple different funds. Something like QYLD that I started buying almost a half decade ago has been dropping in price for several years, and even though the distributions were still coming in pretty hot, my overall investment started to decay. Now, again, this isn't always the case. It once again depends on the underlying asset that the covered call style ETF is tracking or holding, and or the strategy, objectives, etc. Now, during bear markets, they can lose value. A lot of investors always leave comments and say things like, well, this covered call ETF is doing well, but what in the world is going to happen during a bear market? What's going to happen when the market drops? What's going to happen when the underlying drops? And I always simply say that yes, the covered call ETF will most likely drop along with it. I don't understand why that's so confusing to people. I guess it's probably because a lot of people look at covered call style ETFs as sort of this too good to be true investment, which it of course is not. During bear markets, they can lose value just like anything else. Now, this is also important. This is another con. They might take longer to recover since the upside is going to be capped. If a covered call ETF drops $10 per share, let's say, and then the underlying recovers very quickly, it's not going to recover as fast as the underlying because, again, the upside is going to be capped. It might take multiple weeks or months of a massive bull market for you to see the ETF to regain its value. But now it's also important to note that different covered call ETFs might write call options, far out of the money, at the money, etc., etc. It's very important to understand what you're buying into. Now, I promised you guys there's tons of pros, but also lots of cons. Fund managers are also in control of your investment, which maybe you don't like. These funds a lot of times are going to underperform in most market conditions. Comparing it to the underlying, I'm saying, if volatility is shut off, there's not necessarily going to be as much option premium. So that, for the most part, is all you need to know about covered call ETF investing. There's tons of pros, tons of cons, and the biggest takeaway I want to leave with all of you guys is look into the specific covered call style ETF that you're interested in investing into. Because again, not all covered call style ETFs are equal. Now, before you go, I do have one last question for you guys down below. When it comes to covered call style ETFs, what's your number one favorite? What's the one ETF that you love compared to all others? Drop the ticker symbol in my comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.